right? A lot of people think, oh, the dollar's going up over the next 6 months or 2 years. So my first step of leaving Goldman was realizing I didn't want to be at Goldman. Is that, it's not me. I loved Goldman Sachs for many things. Probably the world's greatest network, to be truthful. And you're around some of the smartest people in the world, but you're confined. You're confined in how you are, what you do, in a way that, I just knew that wasn't me. I've always been quite individual. I like to do things differently. And so I saw the recession coming in 2000 and I wanted to trade it. I've been lucky. It's been like being taught acting by Robert De Niro and Al Pacino and whatever, because I got to speak to the world's most famous hedge fund managers all day. Paul Tudor Jones and Lewis Bacon and Stan Druckenmiller and you name it. So I thought, I want to give this a go. And so I went to, luckily, one of my biggest client, in fact, hired me, which is GLG Partners, which was a giant hedge fund firm in London at the time that ended up turning into Man Group. And I started a macro book there, and after about 3 months of doing well, 6 months doing well, they said, well, listen, why don't we start a macro fund? So I co-ran it with another guy called Ben Gill, and we started that fund and built that one up. But over that period of time, it was much more entrepreneurial. GLG was a great place. I was losing my mojo with macro. I didn't have a great year in my last year there. It wasn't a disaster, but it wasn't great. But it's how the industry had changed. It had gone from being this gunslinger's high volatility, long-term conviction world to asset gathering. Low volatility, lower returns. And that was the rise of the pension funds and insurance companies piling huge amounts of money in the space. And they said, we don't want 15%, 20% volatility. And we're prepared to not have 30% plus returns in great years or more. What we actually want is to look more like a bond plus. We want 6% volatility and we want 8% returns. And I'm like, it's not my game. It's just, I don't enjoy that. And I could see that was the death of the industry because it was forcing people to be shorter term in their time horizons. So macro, Paul Tudor Jones told me a great thing was what makes a great investor in his mind is somebody whose idea horizon matches his trade time horizon. Right? A lot of people think, oh, the dollar's going up over the next 6 months or 2 years, and they trade in and out of it. Or the opposite is true, is they're short-term traders by nature because they have to be at this monthly P&L. And every position basically gets reset every month because your investors go, well, why did you screw up last month? They don't look at where you bought something and where you sold it in the industry. Unlike VC, in the hedge fund industry, it's where you were marked last month.
Yeah, it's mark to market.
So it's crazy. So what it means that everybody's time horizon is this 2 week to 2 month time horizon, yet your idea horizon, because it's macro, is in economic terms, which is 18 months or so. To go from peak economic cycle to trough recession, that's a 2.5 year thing. And it gets interesting to trading from macro for about an 18-month period, but you can't do it. So I'm like, this is useless. So I kind of defiantly left and decided to opt out of the rat race and move to Spain because quality of life is something that always mattered to me a lot.
You were in London?
You were in London before. Okay. Yeah. And I thought, what's the whole game for if it's not for quality of life? I mean, money's just an output, but the real thing that you're actually working your balls off for is quality of life. So I moved to Spain, and I realized that I'd had a lot of experience in macro versus most, and I had also learned how to write. I was writing at Goldman. We had this group chat that was very early group chat days, like an AOL group chat thing that I used to run for the whole firm and became very well known for it. So from the chairman down, everybody would read my stuff. And then I wrote an article after a business trip to China when I was at the hedge fund called There's Something Wrong in Paradise, when I turned up to China to expect to see all this, all the amazing stories I was reading and getting from analysts, and turned up and there was just empty buildings after empty buildings. And I'm like,
you and Carson Block.
And I'm like, oh my God, this is a disaster. So I wrote it all up, and I think Stan Druckenmiller got 7 copies. And so I realized that if something like that could go viral, and I knew how these guys spoke, and I knew how they thought, I should write research so I can stay in the markets myself and invest, but also have my hand. And so just by word of mouth, Global Macro Investor grew from Goldman Sachs and GLG backing me, saying, yeah, we'll definitely sign up, to the world's most famous hedge fund managers, family offices, sovereign wealth funds, and everybody else. So that was the first stab at being entrepreneurial, visual person. So I distill everything into imagery. So, which is why macro so appealed to me, because macro is this massive 3D, always changing map of the world, of all the asset classes, how they're interrelated, the economies and the news flow. And I found I can hold it in my head. And I can kind of spin it around and look at it and take different component parts aside. And therefore, you can simplify it if you can make a picture of it. And so I just create that mental picture for others, because most others struggle to see the connections, to see how this could be. People can think one step ahead, but people don't think 2 and 3. And 2 and 3 is where I'm pretty good at, which is longer term, knock-on effects, how this is going to play out. That doesn't mean I get all of them right, but I've been consistently pretty good at that over time. And I can explain it to people in a way that they understand it and can grasp it, whether they disagree or agree. I mean, again, that's the beautiful thing about Global Macro Investor. I've had people who barely ever agree with me, and they've been subscribers for 18 years. I lie. There's probably Chris Benodi. There's like 2 or 3. Basically, that's why they turn into family offices. Because you can't play that game. The best investors the best investor I ever saw, bar none, was Nick Raditi, who used to work for George Soros. And he was you won't find much on the internet. I can see you Googling it. He is super secretive. And he came across my time horizon when in 1991 he was the highest paid man in England. And everyone was like, who the hell is this guy? And he lives above a shop in Hampstead High Street, which is a suburb of London, and became legendary. And I got to meet him, but he was legendary at Goldman and other investment banks for how he traded. I mean, he was a polymath, so he knew in depth about more things than you and I even know exist. And incredible. And Nick was an older gentleman from Zimbabwe, or Rhodesia at the time. He didn't have a Bloomberg screen. He used to read the FT. There would be a grandfather clock ticking, tick, 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 when you go to his office. He would throw out analysts who turned up who weren't prepared, who didn't know their stuff in depth. But when he took risk, he took obscene risk. Obscene long-term positions. If you read anything by Stan Druckenmiller and George Soros, they're like, no, Nick's the guy. Because Nick could see the world in ways that others couldn't see, and have the conviction to have enormous leverage. So Nick was the guy who would have the 300% up year, but Nick would be the guy who would have the 40% down year. But he was astonishing. I never forget him calling up the futures guys at Goldman and said he'd bought a ridiculous position in German Bund futures, super leveraged. And he called up like 4 weeks later after putting the trade on. He goes, those Bund things I bought, where are they now? And the guy goes, well, Nick, let me just check. Well, they've kind of gone quite a lot against you. He goes, oh, that's unfortunate. I didn't realise that. I tell you what, let's just double up, shall we? Puts the phone down. I mean, astonishing. But the depth of his knowledge. I went in to talk, I launched a hedge fund, an agricultural hedge fund. I went talking about agriculture. And Nick is so amazing. Firstly, he's listening to my thesis and goes, well, that's interesting, Raoul. Because that reminds me of a paper that was sent to me, I think in 66. Let me just get it. I haven't seen it since then. He remembers this paper. He takes it out, dusts it off. It's somebody's PhD paper on crop yields. I'm like, wow. And I said to him, how are you interested? He goes, I'm not really interested in your fund, Raoul, because I've got these positions on myself. He said, it's really interesting because I took my wife and we hired a plane and we flew across Ukraine and all of the Soviet breadbasket just to see what the fields looked like, the wheat fields, where the borders lie. He said, I then took my wife in a car and drove across the Midwest because I wanted to see what the cornfields were like and the wheat fields and how it felt in the scale. I'm like, so So he would do this kind of work.
Yeah, etc.
I wrote a whole piece on this. This is the best instruction I can give. Firstly, I advise everybody, if you're trying to trade longer term, which is where I think the alpha is, the real outperformance is because everybody's time horizon is short, yours should be long. And I set up GMI to prove that, and I've proven it over 17 and a half years. I've got a registered, public track record for GMI members over 17 years that's basically proven that exact point. So here's my example. Oh yeah, so write it down, and every time you go and try and sell something or change your position, ask yourself, has something changed versus your thesis? So a lot of people, their thesis changed, but they hold on to the position because they're emotionally attached. We've all done that. Or the other one is you get spooked out of something and you forget your thesis in the first place, and then then it goes back and you're like, shit, I've missed it. So let me tell you my crypto investments, my Bitcoin investment story, because it highlights it the best. Because I just recently went through the maths of this and I kind of shocked myself. So I first heard about Bitcoin during the European crisis in 2012. I realized that this was a solution to a lot of the global financial system, and I wrote the first macro strategy piece on Bitcoin probably ever published in Global Macro Investor in 2013. And it was driven by a friend of mine, Emil Woods, who's very well known in the space, and Chad Cascarello, who are Global Macro Investor subscribers, saying, listen, you need to look at Bitcoin. So I looked at it. They happened to have started an exchange called ItBit, which is now Paxos, and I ended up buying Bitcoin. And I stuck a decent size in because my analysis was, it's at $200 now. If I back out the analysis versus the stock to flow of gold, this is worth $1 million with gold at these current prices. Therefore, it's underpriced. I hadn't figured out anything else about network effects, but I kind of understood that this was potentially important, and I assumed that it would go to zero. So my downside was 200, my upside was 999,000, blah, blah, blah. And then I said, I assume that I am a total idiot, which I try and assume most of the time, and therefore I'm 90% wrong. So if the upside is 100,000, and it's $200, it's the best risk reward any of us will ever come across in our entire lives, and maybe one of the best risk rewards of all time. So I took that bet, right? Macro thesis, did the work, said this is probably a 10-year play, and I'm going to hold it. So first thing that happens, I put the position on, it goes up 100%. It goes up 100% a month and 500% in the next 4 months. I'm like, holy shit. I don't sell any because I've got a long-term thesis and it's fresh in my mind. It then falls 85%, but luckily back to my entry level. So it gets back to 200. I don't do anything because I had a long-term thesis. And then I kind of forgot about it. And then 2017, it starts coming to life again, and it's starting to scream higher. And now it's at 2,000, so 2,200. And I'm like, okay, I'm up 10x, which is good. My thesis obviously was a lot more, but I'd forgotten that because now the forking wars had started. And I suddenly thought, is this existential? Is this the S-curve moment where it fails? So I sold it. It went up another 10x to 20,000. I didn't worry about that because I'd made 10x and it was okay. It was a good trade. And I was worried that it wasn't going to be able to play out my thesis because of these forking wars. And then it fell 85%. I wasn't in it. And eventually I got in April 2020. And I can't remember what my average was. Call it 6,800 or something. And then I'm still long, and then rotated into ETH and did other stuff. But anyway, so great trade, one of the best trade of my life. I went back and looked at if I just kept my initial investment at $200, I would have done. I can't remember them 5 times better, even though the size that I added in March 2020 was massively larger than the first size.
Interesting.
Still didn't work. I'm like, huh. And then I thought, okay, if I'd actually followed my thesis, which is when it gets very oversold, and it gets to that kind of logarithmic, the bottom, the 2 standard deviations oversold of a logarithmic channel or whatever, if I'd actually just doubled my position every time, but not doubled it, sorry, just added the same amount as my initial seed investment, I'd have done like 25x. I'm like, okay. So what I thought was a great trade was actually a terrible trade because I didn't trade my plan and I didn't think about what I was trying to achieve. So that leads into the question about, okay, the market sell off now. I'm immensely comfortable because I see the network adoption. I've got even more models to understand how this space works. I see how broad and deep the talent, the adoption, the kind of conversations that Greg and I have with people all the time, you know, it's like seeing the future. So therefore the volatility now, I've been adding as fast as I can, scraping the sofa for coins, anything to put more money in. What's the optical effect that's actually quite hard is once you've had a big gain and it's, you know, even though it's come off a lot, it's still a reasonable amount of money and you don't have that much capital available to double it up. And it doesn't feel like your position's getting much bigger. And I'm struggling with this right now because, you know, I'm increasing like by 10% or 20% because I don't have the cash to do that. But because I've got a big picture framework that is robust and tested and is deep. I've done a lot of work on it. So I feel comfortable with the probabilities. Now, I love markets like anybody else. So I've got on my screen the real-time chart of ETH daily, weekly, monthly, and hourly. I don't even trade ETH. I just buy it. But I like the market and I look at the price action, and what I did the whole period was just didn't look at my P&L. So I have learned, and this is a new thing for me, how to disassociate myself with my P&L. Because if not, you're always thinking peak to drawdown, or look how much it's worth now, as opposed to how far are we along in my thesis. Let the numbers take care of themselves over time. I'm learning that because, you know, this is a hard one to learn on because the volatility is so high. But I've done it similarly. I mean, I had a very strong view in 2012 about the US dollar and the euro. I was living in euros, billing in euros. You know, GMI was based in euros. I was living in Spain, and I thought, based on a bunch of work that I'd done, that the euro was going to fall over a long period of time. And it was going to fall to 85 cents. 82 cents was my target and has been my target since then. So I took all of my savings, which was a reasonable amount at the time, and stuck it all into dollars. Then to force myself not to trade it, I bought a couple of properties, one in Cayman and a small place in Miami, in dollars. So I couldn't, therefore, and I was now in the trade properly, and I changed the billing of Global Macro Investor in dollars. And that was a phenomenal bet because that was at 148.5 in the euro. Still hasn't got to my target, but it was there, you know. So I've done it once, but that was easier. This one, Bitcoin's harder. Otherwise, I don't tend to run so many really long-term, massively volatile positions. My positions are normally 6 months to 2 years.